Hi guys, welcome back. Today we will be having the introduction to relevant costing for short-term decisions. Let us start with decision making. Decision making is the process of choosing among competing alternatives available. If you are to choose between product A and product B, you can only select one to offer. You are basically making a decision. But in business, who is responsible for making the decision? Decision making is a management function. It's one of the activities of managers, not accountants. I repeat, managers, not accountants, are responsible for decision making. Accountants, however, have a support role in providing info that matters to the decision. This is what this lecture is all about: the role of the management accountant when it comes to decision making. What's the role of the management accountant? To provide the info necessary to facilitate decision making. Before we go there, it is important to make a distinction between qualitative and quantitative information. Information that is qualitative cannot be put into numbers, while quantitative information can be put into numbers. While both qualitative and quantitative information can be pertinent in a decision, management accountants are skilled in dealing with the quantitative aspect, the number crunching. To be specific, they would deal with the financial information, those that can be expressed in monetary amounts. However, not all financial information matter to a decision. So the next question would be, for financial information to matter in a decision, what characteristics should it possess? I'm going to use the term relevant costs to refer to the financial information that matter in a decision. Although I use the word costs, the concept applies to other financial items such as revenue as well. So what makes a cost relevant? For a cost to be relevant, it should be incurred in the future. And it should differ among the alternatives. Both of these characteristics should concur in order for the item to be considered a relevant cost. To demonstrate the concept of relevant cost, let us refer to the following demonstration in a sample case. In this decision problem, the question is, should you take up a master's degree? I am going to show some cost items and tell me whether they are relevant or irrelevant in such a decision problem. First, the cost of tuition fees. Are these relevant or not? This is relevant. Tuition fees are relevant because they are to be incurred in the future and they differ among the alternatives available. The alternatives are basically yes or no. You would take the master's degree or you would not take the master's degree. You're going to spend on tuition fees only if you're going to take up the master's degree, making it a relevant cost. Again, both characteristics, future and differ, should concur in order for the cost to be relevant. Second cost item, the cost of bath soap. Is this relevant? No, this is not relevant. No, of course this is not relevant. Although the cost of the bath soap is to be incurred in the future, it would not differ among the alternatives available. That is, whether you take up the master's degree or not, you're going to buy the bath soap. Or at least, that is what I presume. Again, for costs to be relevant, it should be incurred in the future and differ among the alternatives. Both of these characteristics must concur in order to classify such costs as relevant to the decision. Let us explore other concepts that would be needed in our future discussions. Sunk costs. A sunk cost is a cost incurred in the past. This is irrelevant in any decision. Considering that one of the requisites of a cost for it to be relevant is that it should be incurred in the future. It follows therefore that sunk costs are always irrelevant in a decision. Whether you're going to do action A or action B, any cost incurred in the past will no longer change. You cannot unincur the costs. However, we should be careful not to be attached to this. In reality, some costs can cause the decision maker to make irrational decisions. They would feel invested in a cause and therefore they are going to push through with a decision. To give you an example, imagine if you went to the movie and paid 300 pesos to watch it. And let us say that halfway through the movie, you realize that the film is terrible. Are you going to walk out of the theater? Of course not. You feel invested in the movie because you paid for the admission ticket. However, if the movie is terrible, it no longer satisfies its purpose, which is to entertain you. So the rational decision is to stop watching the movie. However, because you feel invested with the ticket that you bought, you're going to continue watching that terrible movie. Be careful not to be attached to sunk costs. Next, we also have the concept of opportunity cost. This is the foregone benefit of choosing one alternative over the other. So if you're going to select one alternative, you're going to miss the opportunities presented in the other alternative. Because of that, you are actually incurring an opportunity cost. To give you an example, let's go back to the sample case. If you are going to take up the master's degree, let us assume that you're going to do it full-time. If you are going to do so, you're going to pay for tuition fees. Those are cash outflows. But beyond that, there would be additional costs. Because you're going to take up the master's degree, you are not going to earn the salary that you could be earning when you are working. Thus, when you're going to take up the master's degree, you're going to incur an opportunity cost equivalent to the salary that you could be earning while working. Opportunity cost is not recorded in the books, but this can be relevant. So watch out, considering that this is not recorded but can be relevant. We are going to apply these concepts in the context of short-term decision making. In decision making for the short term, financially, the goal is to maximize the current year profits. This is to be distinguished from long-term decisions where we are going to use capital budgeting to maximize shareholders' wealth. In the short term, our goal, however, is only to increase the current year's profits. Examples of short-term decisions where we are going to apply this would include accept or reject a special order, make or buy a needed component, keep or drop a product line or segment, sell or process further, prioritizing the use of constrained resources. That would be our introduction to short-term decision making. Next, let's talk about accepting or rejecting a special order. Like, share, and subscribe.